Hey everyone, this is Kirk here again at optionalpha.com, where we show you how to make smarter trades. And in today's video, I want to talk about creating unbalanced iron condors. So unbalanced iron condors are only slightly different than a regular or quote unquote balanced iron condor. These strategies are best used when you want to be slightly directional in your setup, but you also want the ability to profit if the stock remains range bound. So you kind of want the best of both worlds. It's a fairly neutral strategy, but you can get a little bit directional with it. Now, to build these condors and create skew to one side, you just need to widen out your strikes on the other side of the trade. So again, if you want to create skew to the bottom side of your trade, you would widen out the strikes on the top side. If you want to create skew to the top side or to the call side, you widen out the strikes on the bottom side or the put side. Now again, take your time in understanding these, and hopefully this video is going to be a great guide for you. So in our case, if we wanted to set up a strategy where we were skewing our position to the top side, what we would do is we would sell an out-of-the-money put. We would then buy an out-of-the-money put that's at a 2 times wider strike than the following two trades that we're going to make, which is selling an out-of-the-money call and buying one out-of-the-money call 1 strike higher. So whatever the width of the strikes is on the call side, you're going to do just a little bit wider, maybe 2 times wider on the put side, so that you have a little bit more risk on the put side. We're going to skew it to the top side. And you can see that's where we get that dotted line here on the profit loss diagram from a regular iron condor, which is that red solid line, to that dotted line, which is just a little bit more skewed to the top side of the market. So what's the risk? Well, your risk is limited to the width of the widest strikes on either end. In this case, we'll use an example where we have a $2 wide width less the credit that you received. So if you took in an $80 credit, then your maximum risk would be only $1.20. Should the stock remain neutral in trading at the short strikes, you could make at most the net credit received from entering the trade. So that's ideally what we want to see happen, is still the stock trade in between those short strikes that we sold on either end. But if it does move outside of that range, then we have the potential to lose depending on which side it moves to. An increase in implied volatility definitely has a negative impact on this strategy, everything else being equal, and that's because we're short 2 credit call spreads on either side, or 2 credit spreads on either side of the market. So we ideally want to see implied volatility drop. This is why we said in the beginning of this video tutorial that it's important that we add these strategies when implied volatility is very high. The passage of time does help this position, so theta decay is going to help us since we're net sellers of option premium. So the closer we get to expiration, the faster a profit will start to materialize. As far as break-even points, they're pretty easy to calculate. We're going to take the short at-the-money strikes on either end and add or subtract the credit that we received to get our break-even point. So again, there's 2 break-even points on these strategies. If you want to calculate the higher break-even point, then you take the short at-the-money strike of the call spread, add the credit that we received. If you want to calculate the lower break-even point, you take the short at-the-money strike of the put spread and subtract the credit that we received. And that's exactly how you get both of those break-even points. So we're going to actually go ahead and build one of these strategies right now in our broker platform in Thinkorswim. And this is actually, we're going to build it 2 different ways, and we'll show you what the chart looks like first. So this is a chart of SLV. SLV is a silver ETF, and it's got currently very, very high implied volatility, up in the 71st percentile. And you can see, again, graphically down here that implied volatility is here. So going back historically, this is pretty high over the last year or so. It's been high relatively of late, but right now it's very high definitely as far as implied volatility is concerned. So that kind of meets that requirement for this trade. Now we want to be fairly neutral to this trade, but we are going to play it either way. And so I'll show you how you can play it directionally bullish or directionally bearish. And so the first way that we're going to do it is we're going to play it directionally bullish. So in this case, we'll sell the 16-14 put spread below the market, and that's going to be our $2 wide side of the trade. So you can see here that our 16-14 position has a $2 wide width in strikes. And then we're going to take in a nice healthy credit of 21 cents to do that. On the top side, we're going to be a little bit more conservative and just have the 19-20 call spread above the market. So we'll just adjust our strikes to 19-20. And you can see that that's only a $1 wide spread. So since we have a wider spread below the market, this gives us a little bit of a bullish tilt to this strategy. And so here's what the profit loss diagram looks like. You can see that it's an unbalanced iron condor because we lose a little bit less money on the right side of this payoff diagram as the stock continues to move higher. This is our 1 point wide side. So here the spreads are just 1 point wide, and below the spreads are 2 point wide. So you can see we're fairly neutral. We still want the stock to trade between about 16 and 19, but we have more risk to this side of the trade because we have wider strike prices. Now we can do completely the opposite here. We can narrow the width of the strikes on the put side. So I'll just do that right now. We'll do the 16.15. This is what a regular iron condor would look like. And on the top side, we can widen this out to the 19.21. So in this case, we widen out to the 19.21. Now we have less risk to the downside and we take more risk to the top side of the trade. This is where our $2 wide strikes are, and this is where our $1 wide strikes are. Again, we still want the stock to trade between about 16 and 19, and now most of our risk is to the opposite side. So it's unbalanced with most of the risk higher and less of the risk lower. So it's a really cool strategy, very easy to set up. We really like doing these, and we've currently got a trade right now in SLV that mimics this exact strategy that you see here. We're getting this thing and being a little bit directionally bearish on it because we think the rally up has been a little bit too far, too fast. And so we want to take this trade just a little bit directionally bearish. All right, so as far as key takeaways here, skewing an iron condor is a great way to make a fairly neutral position, but reduce risk on one side of the market, especially if you feel like it could have a big move in one direction versus another. Now, again, this allows you to also play the market slightly directionally against the area of higher risk, which really is a key distinguishing point here. But you do take a little bit more risk on the other side, so just be aware of that. Always analyze your trades before you place the actual orders. As always, hope you guys enjoy these videos. If you have any comments or questions, please add them right below in the lesson page. And until next time, happy trading.